To get started on creating a clear financial plan, you have to start with step 1 on your financial priority list and get your income and bills organized. So how do you actually do that? First, you want to gather and make a list of all your income, your bills, and other expenses. You can find this information by looking at your bank account, credit card statements, or anyone else you spend money from, like PayPal or Venmo. To help you organize all this information, I've provided a template to use in the resource folder of this lecture. If that doesn't work for you, feel free to get organized in whatever way you want. Even a pen and paper will do. Anything that will make this clear and easy for you. Once you get a list of all your income and expenses, you're going to organize them into 5 categories. The first category is your fixed and reoccurring monthly expenses. These are things like rent, your cell phone bill, a car payment, and your gas and electric bill. These are bills that come every month. Whether you get out of bed or not, they're showing up. The second category is listing out all of your minimum debt payments, if you have them. This is the minimum amount of money you owe each month to cover your different creditors. This does not include any additional payment you might be making on top of the minimum. The third category is non-recurring expenses. These are all the other bills or expenses you have throughout the year that just don't happen each month. We often don't save for these, so when they come up, they can easily end up on a credit card. These expenses are both actual bills, like your car registration, insurance, an estimate for home or maintenance, or annual memberships like Costco or Amazon. These non-reoccurring expenses also includes discretionary spending you do throughout the year on things like vacations, gifts, holidays, and birthdays. All of this additional spending needs to be accounted for so you can save for it each month. This is the way to make sure these expenses don't create new debt. To help you organize this information, there is a tab in the template so you can list these items out. Since you might not know exactly how much you spend on each of these things, it's okay to start with an estimate. From there, you can then figure out how much you need to save each month for these expected expenses. This money should be saved in a separate savings account that I like to call your usable savings account. This is just a dedicated savings account where you're holding this money, waiting to spend it at some point throughout the year. Remember, you're not going to fund this usable savings account with your working capital, since this is money you are going to spend throughout the year on your bills and lifestyle. It's just money that doesn't get spent each month, so you need to set it aside so it's there when you need it. So now the fourth category of monthly spending is what I like to call your lifestyle spending. This is the money you're spending day to day when you're out in the world. This includes spending on food, shopping, home goods, fun, beauty, wellness, gasoline, Uber, etc. The first 4 categories is all the spending you do to support your current life and lifestyle, either monthly or throughout the year. The final 5th category is what you spend to work on your goals and dreams. This 5th and final category is your working capital. Remember, your working capital is any money left over at the end of the month that is not being consumed by your current life. If you're currently living paycheck to paycheck, then this will most likely start out at 0. To reach your goals, you need money each month that is not being consumed by your daily life or other annual bills and spending. So your goal going forward is to find a way to maximize this working capital number. In the next lecture, we'll walk through an example to show you how to organize your numbers into these 5 categories. From the previous activity, you should now have your current monthly bills and expenses organized and categorized into our 5 buckets: fixed and reoccurring monthly expenses, minimum debt payments, non-reoccurring expenses, lifestyle spending, and working capital. Since creating working capital is the way you reach your goals, let's talk about how to maximize this number. Here are 3 tips for creating a clear monthly budget that maximizes your working capital. Tip number 1, reduce your fixed monthly bills. Go through your reoccurring expenses and see what you can cut or reduce. Maybe cut the cable cord or get some new quotes on your car insurance or cell phone plan. Or maybe there are some apps or services you don't really need, or you can share with others. Tip number 2, only pay your minimum debt payments. Until you're on step 3, you should only be paying your minimum debt payments. Any extra debt payments you're currently making should get added into your working capital. Tip number 3, create a clear lifestyle spending budget. Lifestyle spending is often the category we all overspend the most, for many reasons. To get a grip on this spending, ask yourself, how much do you really need each week for groceries, restaurants, household expenses, shopping, and fun? We'll talk about additional tips on how to stick to your lifestyle spending shortly. If we look at this for Tony, how can he create more working capital? While there's not much he can do for his minimum debt payments at this point, Tony can reduce some of his reoccurring monthly bills. Some ideas for Tony are, he can get on a cell phone family plan with some friends or family. This should drop his cell phone bill to around $40 a month. He can also change gyms or work out from home for a while and drop his monthly gym membership from $80 to $20 a month. He can also shop his car insurance around and probably get that down from $90 to $60 a month. since his car is a few years older from the last time he got an insurance quote. All three of these together would save Tony $160 a month, which could go towards his working capital. From there, Tony can also reduce his lifestyle spending. Currently, without any focus on this category, Tony is roughly spending $400 a week on his day-to-day expenses. If he can reduce that to roughly $330 a week, or $1,230 a month, that will save him an additional $240 a month. So between reducing his fixed monthly bills and his lifestyle spending, Tony can create $400 in working capital to put towards his financial priority steps. Now it's your turn. As you re-look at your spending in all of these categories, continue to readjust your spending so that you can create more working capital. Get creative and push yourself to really see how much more working capital you can create. This is the time to ask yourself, what are your goals and dreams worth? Once you have your monthly spending and working capital mapped out, the question becomes, how do I implement my plan each month? To help with that, it's really useful to organize your bank accounts and any credit cards, so you're clear on which accounts are for what. This is often the final step to implementing your plan successfully each month. Let's first talk about your bank accounts, and then we'll talk about those credit cards. So how might your bank accounts be organized? To start, I would recommend starting with a minimum of 3 bank accounts. Account number 1 is your primary checking account. You probably already have this, but this is the checking account where your income and bills are paid from. You probably already have this, but this is the checking account where your income and bills are paid from. This is the central hub of your finances. Account number 2 is a designated emergency fund savings account. It's best to have your emergency fund separate from all other savings, so you can always be clear what money is for real emergencies and what's for discretionary use. This will also make it clear when you reach your emergency fund savings goals. Account number 3 is a traditional savings account, which will become your usable savings. This is the savings you do each month to pay for those annual bills and expenses. It's usually at the same bank as your checking account, since money flows in and out of this account more often. To help you gain more clarity around what types of savings accounts these can be, we'll dive more into this in a bit. The next part of getting your accounts ready is deciding what to do with your credit cards. Most of us use credit cards to pay for our bills and everyday spending. However, if you have credit card debt, then they're not really working for you. And it's time to cut those ties, at least for 3 to 6 months while you create new, healthier habits. Overspending on credit cards is taking away from your working capital and your goals. And I know, but I get points. Trust me, the points are not worth it if you're overspending. Credit card companies give you reward points to entice you to spend more, and no points are worth any amount of credit card debt. So what do? Review your credit cards and move all reoccurring and autopay bills back to your primary checking account. If you just can't bring yourself to break up with your credit cards, then at a minimum, dedicate one card to be your bill card. Move all of your autopay and reoccurring bills to this one card. This way you are clear on the amount you need to pay to cover all the bills you owe each month. Setting up your accounts to easily keep track of your budget is key to sticking with it, and having the right accounts and systems in place will empower you to do just that. When it comes to your budget and being successful each month, the most important category to track is your lifestyle spending. This is the category that we are most likely to overspend in. And overspending in your lifestyle is where your budget just blows up. One of the biggest challenges to sticking to your lifestyle budget is keeping track of your spending throughout the month. This is especially challenging when you only have one checking account to track both your monthly bills and your lifestyle budget. This is because your lifestyle budget is mixed in with the money that's waiting to go out to pay your bills. So to help you keep track of your lifestyle spending, here are 4 ideas to try. Option 1. Open a separate checking account dedicated to your lifestyle spending. Then transfer your weekly lifestyle budget into this account and debit from there. You should have a separate debit card for this specific account that you'll use for all your lifestyle spending. You should have a separate debit card for this specific account that you'll use for all your lifestyle spending. The positive aspect of this option is that you can always quickly check this account's balance, so you're clear on where your lifestyle budget stands. Option 2. Get a reloadable debit card. This is similar to a dedicated lifestyle checking account, in that you would transfer your weekly lifestyle budget onto a reloadable debit card. You can also check the balance of this card anytime, so you can always know how much money you have left in the week to spend on your lifestyle needs and wants. Option 1 and 2 are probably the most straightforward. However, there are also these 2 other options. Option 3. Track your lifestyle spending by writing it down or using a budgeting app. There are many budgeting apps available to help you keep track of your spending. Being engaged with the app is key to this option being successful. And lastly, option 4, just go to cash. Withdrawing your weekly lifestyle budget in cash is a clear way to stay on budget. The main challenge here is that we live in a highly digital world, but cash can still work and might even save you some money. So in summary, Creating a system that allows you to always know how much of your lifestyle budget you've used and what's left is usually the most important factor to you reaching your goals. Pick a system and try it out for a few months, and if it's not working, try something else. Don't be surprised if this takes a few months to get right. This is a new tool and habit you're forming. Creating a new habit and changing years of financial history can take time. Remember to be kind to yourself, and remember that wins come in all sizes. Here are some examples of what wins can look like in the first 3 months. Getting more clarity on where your money is going each month is a huge win. Also, knowing your goals and which financial priority step you're on is a great step forward. Looking at your bank account each paycheck or each month is also a great change. Getting your accounts organized. Even just not adding any new debt is a huge win if this is something you've been struggling with in the past. Getting on a lifestyle budget and tracking it is something to be proud of. Not needing debt if an unexpected expense comes up is huge. Another win is growing your savings by $500 or $1,000. While these may feel like small wins, these are actually very significant. These are the wins that are the building blocks to creating a financially secure future. Be proud of these accomplishments. So far, we've talked about organizing your finances, creating working capital, and how to prioritize your goals with the financial priority list. Now I want to take a deeper dive into how you can save more effectively and quickly. This is important not just for creating your emergency fund quickly, or saving for retirement, but for any financial goal you have. So let's dive into the 4 tips to boost your savings. Savings tip number 1, have at least 2 savings accounts. This is so helpful, since it lets you clearly see what money is for your emergency fund, and what is for your usable savings, like an annual bill, or vacation, or other goal. Besides the benefit of keeping this money separate, so you don't accidentally spend your emergency fund on a vacation, it also helps you quickly see where you are with respect to your savings goals. Getting this clear, positive feedback will help you feel organized and stay motivated. Savings tip number 2, treat your savings like a bill and make it an automatic payment each month. Remember, at this point, you have a clear view of what your working capital is each month. If you're on one of the saving steps, then there is money each month already allocated to your savings goal. If you're on one of the saving steps, then there is money each month already allocated to your savings goal. To avoid spending this on your lifestyle or some other expense, set up an automatic payment from your checking account to your designated savings account each month. This is good to do for both your emergency fund and your monthly usable savings amount. Savings tip number 3, reduce your monthly bills. By cutting or lowering some bills, you basically give yourself an instant raise. This increase in income can add to your working capital each month, which can be used to boost your savings. In the resource file, you'll find some ideas for how you can save on your bills each month. And our final savings tip, number 4, increase your income. Of course, this is easier said than done sometimes, but finding ways to make more money will directly increase your working capital and savings amount. Depending on your time and motivation, here are some ways you can make more money. Advocate for a raise based on your performance and time in your role. Here are some ways you can make more money. Advocate for a raise based on your performance and time in your role. Look for overtime or extra hours if your job allows it. Look at new jobs both within your current company and outside. Add on a side hustle or additional part-time job, even if it's temporary. Allocate any bonus or tax refund to your savings goals. So, to recap, the 4 super saving tips are: have at least 2 savings accounts. Treat your savings like a bill each month. Reduce your bills, and give yourself an instant raise and increase your income. Remember, becoming a super saver is really about having a clear goal and strategy. Knowing how much you can save each month, knowing where it will go, and treating it like a bill are all critical to reaching your savings goals. Now that you know how much you can afford to save each month, the question is, where should it go? There are many places you could keep your savings, each offering different risks and benefits. While there are many options, we're going to focus on the 3 most common. These are 1. A traditional bank savings account, 2. A high-yield savings account, and 3. Investments in the stock market. Let's quickly talk about each option. First, we have the traditional bank savings account. Often this comes with your checking account. A big benefit is that having your savings and checking accounts at the same institution enables instant money transfers between the 2 accounts. However, the biggest downside of a traditional bank savings account is the average interest rate that you make on your money is just 0.05%, which is pretty close to zero. A traditional bank savings account is great for your usable savings. You save each month towards your annual bills or vacations, and then when these bills are due, you can quickly transfer the money into your checking account to pay them. And then when these bills are due, you can quickly transfer the money into your checking account to pay them. The second type of savings account is a high-yield savings account. These are very similar to a traditional bank savings account. However, they do offer a higher interest rate. As of today, the average interest rate is about 0.7%, more than 10 times the traditional bank savings rate. These types of accounts are often not offered through your traditional banks, but rather are offered through mainly online banks like Marcus or Ali. Unlike traditional savings accounts, the interest rate in a high-yield savings account moves up and down based on the Federal Reserve rate. So when the Federal Reserve Bank, which is the US government's bank, increases interest rates, you will see an increase in your high-yield savings account rate as well. The main drawback of these accounts is while your money can be transferred at any time, it can take 1 to 3 business days to go between your different financial institutions. The high-yield savings account is a great savings option for your emergency fund. You're able to keep it safe and separate from your monthly spending, so it's there when you need it. But it'll earn more interest than if it was just sitting at your traditional bank. So it's there when you need it, but it'll earn more interest than if it was just sitting at your traditional bank. The third popular savings option is investing in the stock market. This can come in a variety of ways and investment options. You can buy stocks, mutual funds, index funds, or other investments. Investing in the stock market is traditionally not done through your primary bank, but rather a financial institution whose business is buying and selling stocks, like Fidelity, Charles Schwab, Robinhood, and Trade. The best part about investing in the stock market is that you have the potential to earn more money than a savings account. Historically, the long-term growth of the market has been higher than what a savings account offers. However, all that potential growth does come with downside risk. Your money is not protected and your investment can make or lose money at any time. So you don't want to invest money you can't afford to lose. And there are no guarantees that your money will grow, especially in the short term. For these reasons, the stock market can be a good savings option for your goals that have a long-term focus, which is generally over 5 to 7 years. So the stock market is good for things like your retirement savings, or saving for a home you want to buy in the future. But the stock market is not a good place for your emergency fund, or other savings you want in the near term. But the stock market is not a good place for your emergency fund, or other savings you want in the near term. The worst thing would be to put your $25,000 emergency fund into the stock market, then lose your job, and come to find out your emergency fund is now only $15,000. While these are not your only savings options, these are definitely the most common ones you'll probably use. While these are not your only savings options, these are definitely the most common ones you'll probably use. So now that you know where your money can go, the goal is to decide where it should go. So far, we've talked about your financial priority list and ways to become a super saver, so you can reach your emergency fund, retirement, and other goals quickly. Now it's time to tackle debt. Sometimes people label debt as good or bad, which can be confusing. But some debt can help you reach your goals, while other debt keeps you from them. The key is to know the difference. For example, some debt can help you build assets for the future. People will often say that borrowing for your education, for a reliable car, or to buy a home could be a good use of debt. Some people consider loans such as credit card debt, short-term loans, and pawn loans as bad debt. This type of debt often carries high fees and interest, and if they're used for things you consume, like meals out, gifts, or vacation, then they don't help. You build your assets or your net worth. But it's not always that simple. There really is no one type of debt that is always good or always bad for everyone. That's why before you borrow money, it's important to first understand your goal and your need for this money. You also want to have a clear plan for how you'll pay it back. For the next few lectures, we're going to be talking through some debt terms and factors that impact your ability to borrow money and pay it back. Once we have that good foundation, we'll talk about how to effectively pay off the debt that you may have. When we talk about debt, we need to also talk about your credit score and report. This is because if you want to borrow money, the lender, being a person or bank giving you the money, wants to have some sense on if you'll pay it back. Your credit score and report gives them a sense of how likely it is that sense on if you'll pay it back. Your credit score and report gives them a sense of how likely it is that you will pay on time and that they will get their money back. So, if you are seen as a risky person to give money to, then they will charge you more interest for that risk. So, if you are seen as a risky person to give money to, then they will charge you more interest for that risk. So how is your credit report and credit score created? First, your credit report is created when a credit reporting company gathers information from your credit history. What loans or credit cards do you have, and what's your payment history? Have you paid them on time? Do you pay late? And do you miss payments? And how much of your available credit have you already used? Then they take this information and consolidate it into a credit report, and this report gives a picture into how you manage debt. Then from this report, a calculation happens, and you're given a credit score. This calculation depends on 5 main factors. Factor 1, your payment history, meaning any late payments. Factor 2. Your debt utilization ratio, meaning how much of your available credit are you currently using. Factor 3. The length of your credit history. Factor 4. Any new credit you've recently added. And Factor 5. The mix of credit and debt you have. A higher score tells lenders that you handle debt well, make on-time payments, and are more responsible. This makes it easier to qualify for a loan at a lower interest rate. Remember, a higher credit score means you're less of a risk. On the flip side, having a lower credit score tells lenders that you may not pay your loan back on time, or you might skip a payment here and there, making the chances of getting their money back more risky. A lower credit score may also tell lenders that you have too much debt right now, which is a red flag for them. All of this translates to you paying a higher interest rate. When tracking and checking your credit report in the United States, there are currently 3 nationally recognized credit reporting agencies: Equifax, TransUnion, and Experian. Equifax, TransUnion, and Experian. Each of these agencies keeps a credit report on you and creates a credit score that is used to determine if you get a loan, or a credit card, and at what interest rate. Credit scores between these agencies can vary, because they all look at slightly different information and use different formulas for calculating your credit score. As a result, you have more than one credit score. Typically, you'll find that you have 3 credit scores, one from each of these reporting agencies. While your credit score is important for accessing a loan or taking on debt, like a home loan or a credit card, it is also often used for when you're looking for an apartment, insurance, and even for some jobs. So whether you want a loan or not, it's important to check your credit report and score, so it doesn't impact other areas of your life. Before taking on debt, it's important to understand what options are available and what typical interest rates and payment structures are associated with them. This way you are clear what the best loan options are. While there are many types of loans available, I wanted to highlight the most common options you'll likely run into. From generally highest to lowest interest, these are payday loans, credit cards, personal loans, student loans, car or home loans, family and friend loans, and medical debt. Each of these loans come with their own range of interest rates and payment options. To help provide more information on each, you can find a summary of each option in the resources folder. However, in general, payday loans and credit cards have the highest interest rates by far. Payday loans can cost you up to 400%, and credit cards often have an interest rate between 18 to 25%. So for these types of loans, you want to have a clear plan for how to pay these off quickly, since they cost you the most. Personal loans are also pretty costly, having an average interest rate of 8 to 15%. These are most often used to consolidate other debt, like credit card debt. In this scenario, you take out a personal loan at a lower interest rate, so closer to 8 to 15%, and use that loan to pay off your higher interest credit card debt. While financially this sounds like a good plan, consolidating your high-interest credit card debt into one personal loan at a lower interest rate, so you can pay your debt faster and pay less interest overall. Really, this only works if you get on a clear monthly budget and stop using your credit cards completely. Otherwise, the overspending that got you into credit card debt in the first place will continue, and 3 to 5 years from now, you'll find yourself with both credit card debt again and this personal loan. I see it all the time. Remember, higher interest debt, such as payday loans, credit cards, and personal loans, are all debts that you want to focus on paying off as part of Step 3 on your financial priority list. The remainder of the loan options, such as student loans, family friend loans, medical debt, and usually car and home loans, are generally at much lower interest rates, something under 5%. This is the debt that we focus on paying down once you have your 6-month emergency fund in place, and you've started to save for retirement. As you consider various loans and credit cards, it's important to understand the terms of your loan and have a clear plan for how you're going to pay it back. This way you can make the best choice for your financial goals. So you've taken out a loan or you find yourself in debt, so now what? Let's now talk about the different options for getting you out of debt quickly. A big thing to remember is that the faster you can get out of debt, the more money you can save in interest, and the quicker your debt payments can now go towards your other, more exciting goals. So while there are many strategies for paying off your debt, the biggest factor in your success is having a clear plan each month and a way to track your success so you can stay motivated. Remember, you didn't get into debt overnight, so don't expect to get out of it overnight either. But with a clear plan and focus, you can quickly start to see the end in sight. I also want to remind you that you are only focusing on paying off your high-interest debt if you already have 1 to 3 months of bills saved. Paying off high-interest debt is step 3 on your financial priority list. There are 2 primary strategies for paying off debt: the debt snowball method and the avalanche method. While these have similarities, their primary difference is the payoff order and how you organize your debt. In both of these strategies, you do two things. First, you always continue to pay your minimum payments on all your debts. Second, you put 100% of your working capital towards one debt at a time. Remember, this is an additional payment you're making on top of the minimum amount. Now, the main difference between these two methods is how you prioritize which debts to pay off first. The debt snowball method is a debt payment strategy, where you start with paying off the smallest balance first. The debt snowball method is a debt payment strategy, where you start with paying off the smallest balance first. Once that's paid off, you move on to the next lowest balance and so on. Starting with the lowest balance first gives you a win quickly and the motivation to keep going. While this method could cost you more in interest, staying motivated is ultimately the best debt-free plan. The avalanche method, on the other hand, is a debt payment strategy where you pay off your debts based on the highest to lowest interest. By starting with the debt with the highest interest, you can save more money over time. However, if your highest interest debt is also your highest balance, gaining that first win could take some time, impacting your motivation to keep going, which isn't worth it. In the next lecture, let's walk through how Tony would use the debt snowball method to pay off his debts quickly. We made it to the end of the course. First, I want to say congratulations on taking the time to focus on yourself and bettering your life options. We are all so busy these days, so it's truly a gift and commitment to yourself and your family that you put in the time and effort to better understand your money and how it can create choices for your life and generations to come. Second, I would appreciate it if you could take the time to rate and review the course. Tell me what you took away, or what else you'd like to see. I would love to hear your feedback. If you have any questions, you can use the Q&A feature to get in touch with me. And, if you like what you learned in the course, please feel free to share it with others. At the beginning of this course, I talked about what I hoped, at a minimum, you would learn from this course. First, a clear view of your current financial situation. With the financial template provided to you, you should now be able to clearly see where your money is going each month. Remember, you got to know where you're starting from to create a plan for where you're going. Second, I wanted you to walk away with a clear framework for how to think about your money and how to prioritize your different financial goals. These are your 6 financial priority steps. Remember step 1, get clear and organized about your income and expenses. Step 2, save 1 to 3 months worth of bills. Step 3, pay off all high-interest debt. Step 4, boost your emergency fund savings to be at least 6 months worth of bills. Step 5, save for retirement. Then lastly, Step 6, pay off your lower interest debt and save for larger goals. And finally, I hope you're coming away with a new sense of confidence and empowerment that you can control your money and that you can create the financial security and a future you want. Of course, there was so much more information about how to boost your savings and where to save based on your goals. Also the different types of debt and strategies to pay off your debt. And lastly, how do you think and plan for retirement? This was a lot of information, so don't expect that you're going to remember everything. Focus on the financial priorities that you're on, and continue to use this course as a resource to come back to over and over again. I've seen people turn their financial life around in a single moment, and I know you can do it too. 1 month, 6 months, and even a year from now, your life and choices can be very different. You have the tools to make that happen. Now you just have to start using and practicing them. Thank you again for joining me on this money journey.